Good morning, ladies and gentlemen. We start this week's review with a view of the 5-year note yield, which is a better indicator than the futures because of the rolls. And if we enlarge it, we can see that this pennant is now getting to a very interesting phase. We thought there might be a chance to the downside after the data on Friday NFP. It looks like the chances are for an acceleration to the upside. We have a very critical level here around 284. In terms of yield, we've gone through the top of the Bollingers in the daily. We expect 2 or 3 days of consolidation, and then for us to try this 283, 284 yield level. If by the end of the week or the end of sometime next week, the week after rather, we are through this 284 level, this would be an excellent indicator that we are definitely going to try to exceed the highs at 294, which we made so many months ago. On the other hand, the chart of the 10-year, and this is the 10-year, is nowhere near as bearish in terms of price, bullish in terms of yield as the 5-year. The yield curve keeps on flattening, and that is also in evidence here. We are no more likely to break the highs, but we are probably likely to fill this gap around 305. I would expect the market to slowly make its way up to 305 and then not have the strength to go through it, while the 5-year probably gets to around 3. So we're looking for the spread between the 5-year note and the 10-year note to go to almost zero. As we all know, everybody is looking at the yield curve as some sort of a predictor of future economic activity. We're not so sure that that is correct at this point of time. We wouldn't read too much into it, but we certainly think now that the doubts that everybody had down here are being removed, and we can certainly get to around 3% to 305 in the immediate future, and then we will see. If we look at the yield differentials between German and US rates, in the 10-year we see that nothing much has changed. 258 remains the level. If we break through there, and I don't think we are going to do that in a hurry in the next few days, that will be the signal for a trend in the dollar, which could be quite large. You can see how long we've consolidated in this range, 258 to basically 246. It would be reasonable to expect at least a 12 basis point move to the upside if we break it, so around the 270 area. And that would certainly strengthen the dollar quite a bit. But for the moment we don't see it. We think they're still in the range, and therefore 10-year notes and bonds are more or less tied together. As you can see, the bund in Europe is now starting to accelerate upwards. We do expect a break of 41, 42, but that should take us no higher than 48 to 49, maybe 50 basis points. We would have thought a lot of offers are there at 50 basis points. So that is basically 11 basis points, which is more or less exactly what we're looking for in the 10-year note. So the message is quite clear. Bonds and 10-year notes in the States up a dozen basis points, while there's probably slightly more room for the belly of the curve, 2s to 7s, i.e. 5-year notes in the States, to go a little bit more than that and flatten the curve even further. For us, the big development last week was actually how firm volatility traded, and also the fact that it refused to make new lows, as certainly in this trend, as the market made new highs the week before last. And that was a very good indicator that the equity markets in the States could not sustain their highs, those new highs, and that there was room for a retracement. 2865 and 1550 basically were the levels that volatility couldn't break. 1550 is a very important level, but as you know, the 16s are also extremely important. What do we think is happening here? We think that people are buying protection. People are realizing that if the yield curve is going to go flat to negative, if rates are going to go higher, if the Fed is going to tighten as much as people first of all thought and then didn't think, but now think again, then the equity market at some stage is going to be in trouble, and people are beginning to hedge. That is not a bad thing. It just means that the market is going to be in a better position to sustain rallies when it can sustain rallies. So we don't think there's anything that we need to particularly worry about in the next week or so, but it's certainly an indicator that something much bigger is brewing way down the road. Maybe for October, maybe for November. Everybody's expecting a huge upside in the fourth quarter. Well, maybe we get the opposite. But it's far too early to think about that. What's most important is to realize that we are beginning to get some very important divergences from volatility, and that is going to be our canary in the coal mine in future weeks. Before we look at the equities, I wanted to show you again how little damage was done last week in terms of spread behavior. Our indicator is still very high. It has in fact not moved at all last week. The model score is 83 and was 83 throughout the week. That means that this little pullback to 2865, which we identified to the tick, has done absolutely nothing to the model score. All the spreads are still, well, nearly all the spreads are extremely positive and in risk-on territory. This would need to move quite substantially towards zero. We are so close to the maximum, which is plus 100, which basically is telling us there is no need to worry at the moment for a larger correction. We are still in a trading market. We are not in a trending market down. You look in this kind of market, you look for opportunities to buy, and we will now examine the very important levels for the next week ahead in equities. And here we are with the weekly S&Ps. If we now enlarge this, we will see that why this level was so important. 2865, it's exactly where these moving averages came in, and we've been saying all week that if we break those, then we are likely to go down to meet this red moving average, which has held the market nearly all the time this year, but that comes in just below 2800. We think it's unlikely that we go there. We think there's more of a chance that we now stay in a sideways pattern bounded by the 2900s, and then at some stage probably do a false break before we accelerate higher again. So all in all, until volatility gives us a much better signal, it gave us a wonderful signal last week to get out of the top and basically cover at the bottom. Now we are, volatility is saying that we are probably likely to do some backing and filling in volatility, which would allow us probably to go higher from these levels. If we come down to the 10-minute charts on the SPX, we actually see how well contained the selling last week was. The very important levels are actually going to be right here around the 28.94 level. If we I have very little doubt that at some stage next week we will trade 28.94. What we do there is going to be very important. We would prefer this to be an A, B, C, and then come down and fill all these gaps that we have towards the 28 to 25 level. But we are keeping an open mind. Volatility has done what we wanted it to do. Now we think it's more likely that we stop out all the bad shorts who actually got short around here, probably in the 70s. We stop them out, and then we would like to see a continuation lower, but we've got an open mind. The market is in a risk-on phase, and there will be flows out of fixed income back into equities. That seems to be quite clear to us. So we think the downside in equities is actually quite contained, and we would prefer to be buyers of dips rather than sellers of rips at the moment. Apart from around the 28.94-95 level, we think it's worthwhile selling there with probably a 10-point stop, because the risk reward is at least 3 to 4 to 5 to 1. And when we get there, we'll probably think of some good option strategies for you. The one market that got hit pretty hard last week was the Nasdaq, and it was about time too. We think the Nasdaq, certainly for the next few weeks, is in a kind of consolidation mode. This is a daily chart. We would certainly expect the Nasdaq at some stage to maybe test 72.90. That does not contrast in the slightest with our view of S&Ps. The Nasdaq is a completely different animal. We would really like to see it around the 72.90 area and then higher. So we don't think that even the Nasdaq is a bad buy. We've had 4 days of selling. We might get a fifth or a sixth, but then at some stage we will go back up because the tech sector, it has to be a leader in S&Ps, otherwise the S&Ps just lose traction. You will all remember this chart of Dow Jones over the Qs. Well, and you'll remember this level here. When we got there, we said get out of the Qs, get into the Dow. Well, it's now at critical levels. If it breaks here, technology is going to be quite a bit weaker, and it'll show you that people are slightly defensive. Being defensive within the equity sector does not mean being risk off. It just means that for the next few days or weeks, defensive sectors are leading as opposed to aggressive sectors. But that does not mean that the overall market has to go down. If you look at the Dow last week, the Dow actually closed unchanged on the week while the tech sector got slammed. Doesn't mean you can't go to the 200-day moving average, but that to us is actually a healthy sign. If we see the market down here, we'll be up here rather, we'll be very, very prepared to go aggressively long of technology stocks. On to Europe, which is a completely different animal to the United States at the moment. This is a weekly chart, and if we actually enlarge it, it just shows you how much more bearish than the S&P's Europe is. We have our objective, which is here around 11,430. We are oversold. We're through the Bollinger Bands on the weeklies. Won't even mention the dailies. What do we think is likely to happen? We think this is likely to happen. A series of violent up and downs hopefully reaching our objective at 11,430, when we will be ready to start going up. We think this is a very long ABC, but please write that level down. 11,430 is going to be the level that we are looking for to buy structurally for the next few years rather than trading it. We are likely to experience quite a bit of volatility in the DAX over the next few weeks as the market fills these levels underneath. In the short term, actually, the DAX has touched a very important level almost to the tick. So together with the S&Ps, we would not be surprised if it now started rallying and testing the 12,150 level. That is 200 points from here, and it's certainly playable, but we don't think it's going to be quick, and we don't think it's going to be impulsive. It's just going to be a retracement of this huge move, and then we've probably got another leg lower. So 12,150 is the level that we're looking for sometime next week, probably to buy some put spreads, and we will tweet you when we get there. We want to show you the Dow because the correlation between the indices is getting weaker and weaker. You will remember that the S&Ps broke through the top moving averages and moved to lower ones. Well, the Dow has done nothing of the sort. The Dow has held all week on a closing basis this moving average. This to us suggests that we have room probably to rally towards the 26,300, but also suggests to us that people are buying much more defensive stocks and getting rid of their very aggressive stocks, which is a foretaste of the positioning that people will want to have, i.e. much more value orientated as this rally matures, because this is, make no mistake, a very mature rally. Whether it gets to 3,000 the SPX or doesn't, we're only talking 3 or 4%, aren't we? So people realize that we are in an uncertain time. That is why they've been buying protection via volatility, and that is why they're positioning themselves much more defensively. That could get all blown out by a surge, but we just think that the odds of that are very, very low. Everything we've said so far is actually borne out by the transports, which we think are very often a leading indicator. If we look at what they're doing, well, how is that bearish? There's very little bearish here. What's happened over the course of the last 4 days? Nothing. The market is slightly higher. Therefore, this movement has been solely out of technology and very aggressive stocks and into much more value orientated stocks. Can the market go a lot higher? Probably not. But certainly, what are the odds of it going much lower? Also not very good, which basically gives us our range in the S&Ps just north of 29,000 at best, probably just around 2,900, and just probably bounded by that 65 level, and there is a very slight possibility that we go into the 30s or 40s and then come straight back up to 65, but we wouldn't bet on it. We think it's much more likely that the market trades 28.95 next week as a 75% chance than anything else happening. Moving on to the dollar, we think it's highly likely that we actually trade sideways for quite some time, simply because we are, as we showed you, we are not really in a position or we doubt that we are in a position to break that 258, 259 yield spread between 10-year notes and bonds, and therefore odds are that we will be remaining within this 96.50 to 93.63 level in the DX. You can see how flat everything is. Yes, these are trending up a bit, but not a lot is happening. We are better buyers of dollars from lower levels. We think the odds of trading 96.50 are slightly higher than the odds of trading 93.63, or certainly breaking it. Therefore, we want to be buying dollars every time it dips for a trade, but we don't think that we are in a position anytime soon to break 96.50. And so on to the biases. What did we say last week? Well, we said the situation is unsustainable in 5s and 10s. Now we're saying watch the 5-year note. The short is 113.05 with a 113.16 stop. That's going to be the high risk reward trade, and we will certainly tweet it to you when we get there, or maybe some options. Still nothing going on in Bunds and Bobble, much following what the States is doing, so nothing particularly interesting to say there. SPX, it's binary. If we can't break 28.65, we will go back up towards 29.15.30 in a couple of weeks, but for next week 28.95 to 00 should be the pivot or the top. So we basically sit between 28.65 and 28.95 00. If we were to break 28.65, which we don't expect, we could have a cascade down to 2800, but that would have to be prompted by some news, something unforeseen at the moment. Most likely it would be just a quick stop run, and then we go back up to 28.65 and go back to the story of 28.95 to 2900. So we are not as bearish by any stretch of the imagination. We are more bullish, and we definitely think there's a 75% odd chance that we trade this level sometime next week. NQ is looking more vulnerable, but there is no confirmation that anything big is going on. As we showed you, there are some very good support levels right underneath this market, and we don't think that more than 1% on the downside, 1.5% down on the downside is likely next week in the NQ. We said last week, don't be short of volatility. No reason to pick up pennies in front of a steamroller. We were right. Now we say we've probably seen 1550 being the top. If we see around the 1450 level, we will want to buy it again. 1450 to 1425 is going to be the level that we'll be interested in buying volatility again. European equities, we explained what we think is going on. We think it's going to be very volatile, but we saw that level 11,450, call it, in the DAX. That is what we would like to buy for the long term. And finally, no change at all here, 96.50 or 93.63. We are better buyers, more odds of seeing 96.50 than seeing 93.63, but no great risk reward and therefore no great trade. If we get to 96.50, we'll be more than happy to sell absolutely everything we keep on buying. And at 93.63, we want to do some big stuff. Thank you very much indeed, and tweet you on Monday.